Hello, have a pleasant day. Today's class is accounting entries in the books of Transferor company under the Amalgamation. So, I am Dr. Srimati from Dr. Ambedkar Global Law Institute, Tirupati. Let us see the journal entries. Open a realization account and we have to transfer all the assets except a fictitious asset, as if you know this asset has been given in the balance sheet but for the purpose only, not for calculation, so that value should be reduced. So like a preliminary expenses, underwriting commission, discount on issue of shares or debentures, profit and loss account, particularly debit balance, so at their book values. So what is the entry means? Realization account data to sundry assets account if possible and given in the balance sheet that individual asset means, then we have to take only the individual names. And here you have to note that the cash in hand and cash at bank in the balance sheet, if not taken over by the transferee company, then do not transfer that the same to the realization account. If it is taken over, then it must be transferred to realization account only. So the assets not taken over by the transferee company, if it is not taken, then it should be transferred to realization account. And then the goodwill and other tangible assets, say for example trademark, patent right, all should be transferred to realization account provided if they have any sale value, that is realizable value, and they are taken over by the transferee company. So transfer the liabilities, as if in first journal entry we have seen the transfer of asset. So now transfer the liabilities taken over by the transferee company to that realization account. So individually, if possible, you can write it as sundry liabilities with the book value to realization account. The total of liabilities we have to write it here. And then on the consideration being due, that is when the company purchases business or there is about, then in such a case the consideration should be paid. For that due is transferee company account debtor, that is name of the company will here come here with the amount of consideration to realization account. And if the any of the asset is not taken over by the transferee company, the same should be realized by the transferor company itself. So when the asset is sold, then what is the journal entry? Bank account to debtor to realization account with the realized value, set the sale value. On receiving consideration from the transferee company, that is shares in transferee company, and then debentures in transferee company, and then bank account, that is cash which has been received. See, in the some cases all the three entries will come, but in some situation any one may come it. So it is according to the consideration, okay. And then to transferee company account. And this is about for the liquidation expenses or realization expenses, which is borne by the transferee company itself. So realization account debtor with the amount of expenditure to bank account. When the expenditure is met, then we want to pay that. So to bank account. If the liquidation expenses or realization expenses are borne by the transferor company, actually no need to put any values. So better not to pass any of the entries in the books of transferor company. Otherwise, we can pass like this, that is transferee company account debtor with the amount of expenditure to bank, and then it seems that it has been met by the transferee company. So that is opposite entry for receiving the reimbursement. And in case liability is not taken over by the same that is transferee company, the same need not be transferred to realization account. So it should be paid off by the uh, transferee company and credited with the actual amount paid. If there is about any profit or loss, then that should be transferred to a realization account. So in case of profit, respective liability account debtor, that is with the difference between the amount due and payable, and then we have to take to realization account. In case of loss, the realization account is debit and to respective liability account. And now pay off the outside liabilities if not taken over by the transferee company, that is respective liability account debtor to bank. So when the debentures are discharged, that is it not assumed or discharged by the transferee company, then debentures account debtor to debenture holders account, debenture holders account debtor to bank with the amount of value which has been paid. Then preference shares, if anything, then the preference share capital account debtor to preference shareholders account. And then shareholders account debtor to, suppose if it has been paid by the transferee company, then preference shares in transferee company, or if it has been paid in the form of equity shares, then equity shares in transferee company, or if it has been paid in form of debentures, then debentures in transferee company or bank. Suppose directly cash is paid to them, then to bank. So as the case may be according to the consideration, how it has been made it. Then close the realization account and transfer the profit or loss on realization to equity shareholders account. So in case of profit, realization account debtor to equity shareholders account. In case of loss, equity shareholders account debtor to realization account. So before the equity shareholders are paid off, we want to transfer other accumulated profits and reserves to equity shareholders account. So equity share capital account debtor, then general reserve account debtor, then reserve fund account debtor, capital reserve, profit and loss account, everything which has been left in the liability side of balance sheet, that should be transferred to equity shareholders account. And then in case of loss, anything which has been in the asset side of the balance sheet, which has not been taken to realization account, that should be transferred to this shareholders account. So equity shareholders account debtor to profit and loss account, that is debit balance, and then preliminary expenses, underwriting commission, discount on issue of shares, discount on issue of debentures. So all this will be paid in the form of two equity shareholders. So paying off the shareholders, closing down the entries. Equity shareholders account debtor to equity shares in transferee company. The mode of payment may be either equity shares or preference shares or debentures or bank, as the case may be. And then here you have to note that the preference shareholders or debentures are paid more or less than the amount due to that as per the balance sheet. So here that should be transferred. Anything is there, that should be transferred to realization account only. And once the equity shareholders are paid off, then there will not be any account opened or that is balanced in any of the account. Not even a single account is opened, and it should be closed. All the accounts are closed when the equity shareholders are paid off. And then the net amount payable to equity shareholders after that adjustment of accumulated profits and reserves or the fictitious asset and profit and loss on realization must be equal to that amount of the consideration which is received, that is shares debentures in transferee company, as well as the cash which has been received from transferee company and left after discharge of all liabilities and preference share capital. So this is about the journal entries, how we have to pass it in the books of Transferor company. See, this is the journal entry which is more same for in case of amalgamation in the nature of merger, that is pooling interest method, or in case of purchase method. The same journal entries we are going to pass in the books of Transferor company. Hope you understood. Stay tuned until the next. It's bye from Srimati. Thank you.